Don't be evil. On April 29, 2004, Google filed its prospectus with the SEC to start the process of becoming a publicly traded company. The document began with a letter from the founders, which contained that famous phrase, a stark departure from the formal nature of the document. Google was entering the world of suits and ties, but it wanted everyone to know that although it walked among them, it would not be one of them. Or, as the very first words of that letter so simply stated, Google is not a conventional company. Thus began their journey to initial public offering, which, as promised, was anything but conventional. Google's path to going public was undoubtedly tied to the timing of its founding. Larry Page and Sergey Brin didn't start the company until 1998, so even as the company grew at a preposterous rate, they weren't ready to go public as the dot-com bubble inflated and then collapsed. With people's appetite for internet companies soured, Google would have to wait to access the public markets. And a funny thing happened in that time. Google started doing fine all on its own. They were consistently profitable by 2002 and were amassing hundreds of millions in cash. So, why go public at all? Well, they sort of had to. Google believed in granting its employees equity, and over time, that number was approaching 500. At that level, a company is required to file public financial statements. So, rather than attempting to buy shares back from employees or doing all the work of public reporting with none of the cash infusion, they decided they might as well take the money. Filing from this position of strength allowed Google the leeway to do things their own way, and boy, did they. First, they decided that they would not be providing any guidance to the investors purchasing shares at offering. They said, "A management team distracted by a series of short-term targets is as pointless as a dieter stepping on a scale every half hour." Second, they set up a share structure that more or less said that the founders would maintain full control over the company, specifically the triumvirate, as they called the group of Brin, Page, and CEO Eric Schmidt. Shareholders would have to trust that they would continue to make wise decisions because they would be unable to remove them otherwise. Finally, shares would be distributed by a process known as a Dutch auction that was wildly different than the traditional IPO process. In a normal process, investment bankers canvass the country, meeting with major accounts, pitching a company, providing information, and establishing pricing on the offering once they know the level of demand for shares. Google did not like this process. They wrote, quote, "It is important to us to have a fair process for our IPO that is inclusive of both small and large investors." They also wrote, "Our goal is to have a share price that reflects a fair market valuation of Google." The auction would work like this. The company would accept bids from individuals and institutions where they would state how many shares they would like to purchase and at what price. They would then assess offers at various price levels until they reached a point where there was enough demand to soak up all the shares Google intended to sell, with some variants allowed to sell fewer shares if the price was lower or more if it was higher. The auction solved Google's fairness concern because whereas normally a person needs millions to get in on an IPO, or at least to be a favored client at an institution that has millions, here, most people could participate. It also solved the fair value concern by allowing for a more market-wide assessment of the securities than would happen normally. Having grown up during the tech bubble, Google was able to witness companies like eBay, Yahoo, and Netscape go public and have their shares go up by more than 100% on the first day. This is basically free money left on the table. Instead of these companies offering shares and getting higher prices, they allowed that surplus to go to institutions who were profiting by flipping the shares they'd just purchased at half the price. Due to the uncertain nature of the auction, Google put a wide range of possible outcomes, stating that they expected to issue about 25 million shares at somewhere between $108 to $135 per share. Although Google was a well-known and profitable company, the reception to their prospectus by the firms in a position to make large investments was not great. There was, as per tradition with tech companies, popular press who balked at the valuation. Google was claiming that it should be valued as much as McDonald's, which seemed crazy to people. More specific to Google's situation, comparisons were drawn between taking part in the auction and gambling, since you didn't really know what you would end up paying. Most importantly, large buyers had their own concerns. Some felt Google didn't have any plan for the money it was about to raise. This makes sense since Google sort of was being forced to go public and had a strong balance sheet already. Still, investors want tech companies to use capital to grow, not to have it sitting in a bank account. They were also upset about not getting special treatment from Google management regarding the ability to take a deeper dive into financials and projections. Then there was the auction. The scholarly research suggests that the reason stocks so often pop on IPO is that deals are purposefully constructed so that happens. These guaranteed pops are the grease that gets the deals done. When a company wants to place billions of dollars in shares, it is a lot easier to find companies willing to make $100 million bets if there's really no risk after all. If the auction really did allow for efficient price, then investors could be stuck with shares that would just stagnate. On the investment banking side of things, there may also have been a more sinister angle. Since they couldn't provide a guaranteed pop to their clients, they were going to make way less in fees. It would not be good for them if Dutch auction IPO then became popular because they would be taking a big hit in their revenue. While institutional investors throughout America were griping, Google suffers a brutal 2-week stretch of negative PR. And it was basically all self-inflicted. Beginning on July 30th, they launched the registration for bidders for the IPO, and then they encountered what they called logistical problems, so they had to extend the window for bidding by a week. Then August 5th, they disclosed that they had failed to register a bunch of options representing over 20 million shares with the SEC. On August 9th, they announced that they had settled a lawsuit with Yahoo, which required them to give their competitor over 300 million worth of shares. This, in turn, would mean that they were probably going to show a loss on their first public quarter. And the cherry on top, August 12th, Playboy releases an issue containing a lengthy interview with Brin and Page. The content isn't necessarily salacious, it's worse than that. It's relevant. This represents a potential violation of the SEC's quiet period rules, where the only information that should be speaking on the company's behalf on the lead up to IPO is the prospectus. This threat isn't just some academic thing either. Earlier in the same year, Salesforce.com, 2004 was a good year for IPOs, they had to delay their IPO after a New York Times article was published during their quiet period, and it was titled, ironically, "It's not Google, it's that other big IPO." Brin and Page had thought they were okay because when they gave the interview, it was prior to the quiet period, but they were mistaken and hadn't anticipated this late publishing. Thankfully, Google found a way to sidestep a delay. They filed an updated S1 containing the entirety of the interview, so yes, Playboy has an article that is officially filed with the SEC. When the dust settled, Google's IPO had not been derailed, but it hadn't come out unscathed either. On August 18th, one day before opening, they announced that, despite the wide pricing range they'd started with, their offering would be below the bottom end. They instead expected to place shares between $85 and $95, and they would be placing far fewer than anticipated to even be able to place them at that price. The next day, it was official. Google would be placing 19.6 million at $85 per share. The Wall Street Journal ran a front-page headline titled, "How Miscalculation and Hubris Hobbled Celebrated Google IPO." Eric Schmidt, after the fact, told the Harvard Business Review that he was on his way to the NASDAQ thinking, "We're screwed." All that was left to see was the price action. But then, shares opened and they started selling immediately for $100. It had popped anyway, despite the auction. Not 100% pop like with eBay or the others, but probably enough to make everyone happy. Nearly 1,000 Google employees became overnight millionaires. Shares reached $200 by November and $300 before a year had passed. All of a sudden, people loved Google. As for the Dutch auction, a few other companies tried it, most notably probably Interactive Brokers, but ultimately it remains an oddity. Thanks for watching, guys. Don't be evil.